Welcome back to the Dividend Uncle, your go-to source for real estate investment trust insights. I know many of you were feeling uneasy as higher interest rates weighed down on our beloved REITs recently. But guess what? The unexpected has happened, and it's time to reassess our strategies. Let's talk about the recent REIT rally and what my next steps are. The surprise from the Fed. Last week, the Federal Reserve left us all flabbergasted when they announced that they would keep interest rates unchanged for the second time in a row. Not only that, they signaled a more cautious and flexible approach to monetary policy, guided by economic data. The result? A remarkable rebound in the REIT market, with the CSOP iEdge S REIT Leaders ETF up 9%, before falling by 3%, sending many of us into a whirlwind of confusion. What to do now? Buy more, sell, or simply hold? Well, it's all about aligning your strategy with your objectives and risk tolerance. So, let me share what I intend to do. 1. Review my portfolio to realign with objectives. The first step I'm taking is a review of my existing REITs portfolio, and here, I want to share my real-life example from my own journey. My intentions for my REITs portfolio are to be diversified across sectors, and generate passive income of about $4,000 a monthly by end of the year. You see, upon closer inspection, I found that my portfolio had too little exposure to the logistics and industrial sector, deviating from my objective of having a well-diversified portfolio. Moreover, this sector has shown remarkable resilience and growth potential, even in challenging times. Hence, I'll be taking the opportunity to invest more in Mapletree Logistics Trust and Capitaland Ascendus Trust. These are solid choices to increase my sector diversification. Of course, I'm not limiting myself to these two. I'll also be considering other high-quality REITs in my journey to a well-diversified portfolio. I also realized my portfolio is falling slightly short of my dividend target, due to Manulife US REIT pausing dividend payout, and other REITs distribution not fully recovered yet. Hence, I am also on a mission to boost my dividend yields by identifying quality dividend boosters, such as Daiwa House Logistics Trust. 2. Start investing now amidst the uncertainties. The prevailing cloud of uncertainty still hangs over the REIT market. But the winds of change are blowing it away. While the impact of high interest rates lingers, there's an expectation that these challenges will slowly fade away. Now, here's the deal: although interest rates are currently high and might continue to affect many REITs for some time, the market is starting to factor in the expectations that interest rates have peaked. As a long-term investor, I'm beginning to invest in quality REITs. Now, if you're wondering which REITs to consider, check out my previous video titled REITs I'm Putting My Money In Right Now. I've discussed blue chips like Capitaland Integrated Commercial Trust. I am also looking at the other hospitality REITs which are doing really well, such as Far East Hospitality Trust and CDL Hospitality Trust. The reason why I think now is a good time to start buying if you have not done so, is that most of the interest rate hikes are likely already behind us. While there's still some uncertainty in the market, it's precisely this uncertainty that's keeping REIT prices relatively low and attractive. Waiting for all uncertainties to clear might mean buying in at much less attractive yields. And waiting for that bottom of the market to start investing may result in missing those important rebounds. 3. Fund my investments starting from the lowest interest rate accounts. In the coming months, I'm setting aside up to $50,000 to invest further in REITs. To make this move, I'll be withdrawing cash progressively from my Mari Bank account, which has been serving me well with a steady 2.88% interest rate. My other cash sources that I can draw from include Endowus money market funds with interest rates of about 4%, and my UOB1 account with interest rates of 5%. You could draw from your savings account with the lowest interest rates. Now, here's why this makes sense. Current dividend yields in the REIT market are hovering at an average of around 6%, which is significantly higher than the interest I'm earning from my bank account. Furthermore, with a promising upside ahead in the REIT sector, this strategic allocation may well be worth the effort. 4. Keep calm and dollar cost average, DCA. Market volatility is a given, and we all know markets don't move in a straight line. By investing now, you're positioning yourself for a potential recovery. So, don't be surprised if you see some of your investments go into the red due to market fluctuations or unexpected bad news. Just look at the volatility of the CSOP iEdge S REIT Leaders ETF, as the market attempts price discovery. The key here is to keep calm and focus on the long term. When the market gets bumpy, a strategy like dollar cost averaging, DCA, can be your best friend. DCA spreads your investments over time, helping you navigate this uneven road to recovery. As the REIT landscape surprises us with its recent rally, my advice is to stay flexible, patient, and true to your investment objectives and risk tolerance. Remember, market uncertainties might persist, but over the long term, our beloved REITs have proven their resilience and ability to provide reliable income. Thank you for joining me on the Dividend Uncle. If you've found this video helpful, please give it a thumbs up and consider subscribing for more insights into the world of real estate investment trusts. And, as always, do your research, stay diversified, and happy investing.